Martin North appeared on the very famous 60 Minutes program, he really stirred things up. A lot of people weren't happy with what Martin had to say. And it's interesting, Martin, everything you said is starting to come true. And back then, 18 months ago on that program, the media went crazy. Everybody thought you were nuts. And now you're not looking so nutty. So it was great. I am so pleased you said yes to come and be on my channel today. Everybody raves about you. Harry Dent thinks that if he could have a Martin North with him in America, his life would be made. He thinks you're the sharpest tool in the shed in Australia. We're pleased to have you with us. And so, Martin, with that, over to you.
Well, thanks, and great to be part of the show. I've no idea what else you're showing. Segment, because, of course, so many people have been fixated on property for so long. And unfortunately, the cracks are beginning to show. So what I wanted to do was just step through some of my data. And those who are watching this and also follow me, some of you will have seen some of these slides, but I want to make a few extra points too. And there will be a chance, I think, then to put some questions later after this session. So without further ado, I have made a few slides. So we might just go to slide 2. Which is the first one. So there may be people who don't understand what we do, and it's very important to understand that we are looking at households and household finance through surveys. We're surveying 1,000 households each week. And so rather than the sort of the high-level, highfalutin economist view of the world, we have a bottom-up view based on real households and what real households are telling us. And that gives us a very, very granular view as to what's going on. It feeds our YouTube channel, Walk the World, a blog, and it also feeds a lot of the work they do with on television and radio and other channels too. So 52,000 households, 1,000 a week. So the last data in this survey was just last week. So this is very current. And if we go to the next slide, you can see that one of the things I look at is what I call household financial confidence. So this is asking about how people are feeling with regard to their financial situation. And unfortunately, the index has been dropping quite a long way down. It was down at 75 last time. That was a little bit of an improvement from the previous month, but this is well below the average. And if you think of 100 as essentially being, middle of the road, it shows you that most households are really concerned about their finances. And if you unpick that, it's to do with incomes not rising, job security degrading quite fast, the cost of living rising, the commitments, particularly loan commitments on mortgages, creating huge issues for many people. And so this is a sort of a bellwether of what's going on. If you look on the next slide, what you can actually see is that not all households are equally feeling it. But interestingly, those with mortgages are actually feeling the most uncomfortable at the moment, and particularly those mortgages that are actually attached to investment properties as well as to unoccupied properties. Interestingly, those without mortgages but with property are a little bit more positive than a couple of weeks ago, and renters are actually feeling a little bit more positive than previously, although it's a very low level, because the rents are coming down. Now, if you're a property investor, of course, you're worrying about repaying the mortgage. You're also worrying about being able to take those rents through the door. And if rents are going down, that's a big issue. And that's one of the things we'll come back to shortly. If we go to the next slide, you can actually just look at some of the drivers. So essentially, this is saying that people are much more concerned about their jobs than they were even a month or two ago. They're actually much more concerned about the savings. So people are dipping into their savings to try and get by at the moment. Many of them are, of course, not really very well off with regard to savings. About 1/3 of households have less than 1 month's savings in the bank, which is not good news. We also saw that the concern about the debt is rising. It's not the interest rate. So the interest rate's coming down for many people. But in fact, the problem is servicing the debt, particularly the mortgage. And so debt servicing has become more of an issue as job security has degraded. You can also look at income, which is actually in real terms, not moving up very much at all. In fact, a lot of people would say that since 2010 or 2011 in Australia, real incomes have not moved up at all. And now the expectation over the next 2 to 3 years is that incomes will actually drop further because we're going to see much higher levels of unemployment. We're going to see companies tightening the throttle on their expenditure, and clearly people costs and wages costs is one of the biggest categories. So expect to see further pressure on wages over the next little while. In terms of the costs of goods, yeah, that is a real problem insofar that the costs of living are rising, and yet incomes are not rising. So that creates a big problem for many people in terms of just trying to manage the day-to-day budgets. And then if you look at net worth, which is trying to put all this together, so money in, money out, assets, liabilities, the average net worth in Australia has actually degraded recently, and that's despite a bit of a bounce back in the stock markets relatively recently. But of course, property prices are now on their way down. So that gives you a bit of a flavour of some of the things that I'm seeing in my surveys. I can go down to postcode level, but that gives you at least a top level view. If we go to the next slide, one of the other things that I measure is what I call mortgage stress. So this is looking at households with mortgages and looking at money coming in versus money going out, and whether they have enough money coming in to service everything. And unfortunately, we're seeing a significant rise in households with cash flow issues with a mortgage. And up until February, we were looking at around 32% of households with a mortgage struggling to make those repayments, balancing money in, money out, sometimes dipping into deposit accounts, sometimes dipping into credit cards to try and actually maintain lifestyle. But that's jumped up now to 38%. And so in the last month, we've had another 100,000 households, and now we've got about 1.4 million households across Australia struggling with their mortgages. That's a really big deal. And what this indicates is that many people are really trying to work out what to do. Unfortunately, my modelling is also, as I project it forward, going to suggest that we're going to see even larger levels of mortgage stress as unemployment continues to grind forward. And of course, there's a big risk after September when some of those government stimuluses are actually taken away. Okay, it was 6.5, now it's 3 million or thereabouts of people on the JobKeeper. Bit of a boo-boo from the government there, but nevertheless, that shows you that there are a lot of people who are not caught in the schemes. And interestingly, I was scratching my head up till yesterday or Friday about why my modelling was suggesting that only around 3 million households would benefit from the government support scheme, where in fact they were claiming 6.5 million. Well, if my modelling was right, theirs was wrong. So if only I had the courage to make my post a few days earlier, I could have called them out before they actually revealed it. But hey, you can't win them all. If you go to the next slide, it's worth looking at the mortgage stress across the states, because it's Tasmania that actually has the highest proportion of households of anybody across Australia. And you might be surprised at that. Not a very large number of households, but part of the issue there is that incomes have been quite compressed. House prices have run through the roof over the last 2 or 3 years. There's been a lot of interstate purchasing in Tasmania. And then you can see that South Australia comes next, then Western Australia. Western Australia, of course, has had issues for a long, long time. Home prices are still 20% down from where they were 4 or 5 years ago in the West. Incomes have been remarkably compressed, and rentals have been dropping as well. So no surprise, perhaps. But then you see the big states, Victoria, New South Wales, and Queensland is slightly the least stress as a proportion. But we're seeing this pretty much wherever you look. So it isn't just in 1 or 2 postcodes. It isn't just in 1 or 2 locations. This is an Australia-wide problem, and it's to do with the fact that we've got very high debt to income ratios. We've had very loose lending standards for years and years. So many people have got bigger mortgages than they should have got. And I don't know whether you saw my post yesterday, but I called out an ABC post that talked about interest-only loans, and they gave 2 specific examples of people who had a portfolio of investment properties with interest-only loans and were completely caught by all the changes that have happened, and they're having to sell. And that's one of the things that I'm seeing. About 8% of investment property owners last month were signaling that they intended to sell. This month, it's gone up to 12% of property investors. So property investors are looking to try and get out while they've got still some equity in the property. And I think that's going to be a really big deal in terms of thinking about how to deal with the property market later. If we look at the next slide, we can also look across at our various segments. So one of the things we do in our model is to slice and dice the data to be able to look at different types of households. And so we have young growing families. That includes some first-time buyers. Young growing families are often the ones who sort of stretch themselves to try and get in the market. And quite recently, the story was that people were being encouraged to get into the market because the market was going to get, go away from there further. And of course, we had the government 95% support scheme as well that came in. So people got dragged in. Only 5% equity. And well, guess what? Prices in many locations are already down 5% from when people bought. So a lot of those first-time buyers are already now seeing their equity being degraded. An object lesson there: be very careful if you go into property with a small amount of money as your deposit, because you lose that first. The bank still holds its deposit, but you lose it first. Then you can see the disadvantaged fringe and the battling urban. So the people on the outskirts of town, in these modern estates or in the high-rise areas. I'm very concerned about some of the dynamics within the high-rise part of the market. There have been a very, very significant number of people who've bought in, bought new off the plan, committed to a transaction that they then discovered was actually not a very good transaction. Plus, of course, the very poor levels of construction that we've got. And then you can see that the other types of households, so this is not just the battlers that are actually being exposed to mortgage stress. We're also seeing some more affluent households. So if you go across the page there, you'll see exclusive professionals. They're the most affluent households. They live in Mossman or Toorak or places like that. Some of them are now under the gun, and they will often have multiple properties. They'll have multiple mortgages, investment properties, interest-only mortgages, and they've been used to a very significant, strong cash flow and an ability to manage their finances quite closely quite often. But suddenly they're finding that their cash flows are being compressed and those mortgage commitments are actually becoming a problem. And in fact, if you go across the page, even the young affluent, so these are perhaps younger people, for example, living at Bondi, if I take a New South Wales example, perhaps bought an apartment or, somewhere, house close to the area of Bondi, now suddenly seeing that prices are falling as well. And even some of the wealthy sector, the wealthy seniors. So wherever you look, this is a world of pain. And if you want to know why it is that I fundamentally believe that property is going down from this point, it's simply because these households are really struggling with making their repayments. And they can go on like this for a little while. So mortgage stress is an early indicator of trouble later. And I'll give you an example. Over in Western Australia, we looked at Mandurah, one of the postcodes over there that I look at very closely. And I was watching mortgage stress rise 2 to 3 to 4 years ago. And then we started to see the defaults rising, and then we started to see the negative equity emerging over in the West. Well, I'm now seeing precisely the same sorts of trends building down the East Coast across a number of different areas, right the way from Brisbane and north, right the way down to New South Wales and Victoria. So I have a nasty suspicion that this is a harbinger of what we're going to see. Mortgage stress is a really good early lead indicator of what's going to happen later. And just to complete my mortgage stress story, if you go to the next slide, you can actually then see the specific postcodes. And I won't go into this in detail, but I just want to make the point that some of these postcodes, for example, quite a few in Victoria, are in those new urban fringe areas where there have been very, very significant developments, many units and apartments being built, often on small lots, often quite a long way out from amenities. And, some of those like Berwick, or if I think of, I can't, sorry, trying to read this on the slide. It's like Pakenham, for example, down in Victoria, places like that. These are large areas where there is very significant numbers of property now for sale. Some of those property investors, but quite a few of those owner occupiers as well. And so I'm beginning to now see the degrading of property prices, specifically in some of these urban areas with very high levels of stress. And so don't be persuaded by the high level indices. By the way, some of the indices now are taken off the market, as it were. Those indices tell you nothing. You have to get granular. You have to understand that movements down individual postcodes are very, very different, and there are unfortunately pools of pain pretty much wherever you look. Now, if I go to the next slide, just quickly on rental stress, because this is something that people talk about less, but we have a considerable number of households, well over 3 million households renting in Australia at the moment. And of that, 1.7 million are in rental stress. In other words, they're struggling with money in, money out. Now, all of this calculation is based on taking account of the government support schemes that are there, and also it takes account of the bank's interest and principal holidays. But nevertheless, these are households in considerable discomfort, and so many of the people who were renting have decided now to break the lease and go back to live with parents or move in with friends. So one of the reasons why property investors should be very nervous is that the pool of people renting is shrinking. We're not having any migration, so effectively we don't have some of the overseas students that would have rented previously, and put all that together, and it's a really big deal. And if you look at the next slide, you can see that, again, we've got information down to a segment level. And not surprisingly, it's the young growing families who are the most stressed, then the disadvantaged fringe and the battling urban. Then you've got some of the more mature families. But again, you're seeing some more affluent households too. So again, rental stress doesn't actually impact just the battlers. It's much more broad and widespread. And that's one of the reasons why I'm very concerned about investment property from this point forward. And if I just move on to the next slide, you can see there that Melbourne 3000 is actually the postcode with the highest level of rental stress. And that's because there were a lot of Airbnbs in that particular postcode. There were also a lot of students that didn't come back. So suddenly, that's a problem. Or the students that are back aren't getting any support from the government. They're not within the support schemes that exist at the moment, and therefore many of them are really struggling. So it's maybe not surprising that we're seeing massive amounts of mortgage stress. And a lot of those properties in 3000 are investment properties, the high-rise investment properties that people were expecting to see significant capital gains. And interestingly, my modeling says that about 60% of property investors never make a return on a cash flow basis. They're completely reliant on the capital appreciation of the property. But if you believe, as I believe, that we could be seeing prices sliding from this point rather than rising from this point, then essentially there's going to be no capital gains. And that means that property investment as an asset class is probably done. And if I just move on to the financial impact then of COVID. So one of the things that we've looked at specifically is where is the impact of COVID hitting households? And what's quite interesting there is that Toowoomba and Mackay up in Queensland, they're some of the most hit households. That's a combination of tourism, a combination of lack of jobs. But you can see there, if you go across the page, there's a whole bunch of places where households are being hit. And on average, 35 to 40% of households have had some financial impact regarding COVID. And that's important because you have to incorporate that into your thinking as to what's going to happen ahead. Right now, we don't know how quickly COVID's going to recover, but at the moment, many households are under the gun. And if you want to go further on that, here's just an example of Sydney, where I've actually mapped the COVID. If you go to the next slide, yeah, thanks. If you look at that, you can actually see there that there is significant hotspots, the red colours, in terms of the count of households impacted negatively by COVID. That's a count figure. But if you then look at the next slide, which is essentially looking at in terms of the proportion of households, that tells you a different story. That tells you that many households down the eastern suburbs, and I'm just looking at Sydney as an example, are actually really feeling the pain with regard to COVID and what's going to happen. So that's one of the reasons why I'm now very concerned about property prices in that particular area, because quite a few of those are actually in the upper end of the market rather than the lower end of the market. And traditionally, you would expect the western suburbs to be the ones most adversely hit, but I'm seeing a different story here. And I could go into similar stories in other geographies too, but I haven't got time to do that. So that's the end of the slide. So if you want to just put the camera back on me, I just want to make a few closing remarks. And then I can pretty much draw this to a close. So there's 4 points I want to make. The first is we have had a tremendous run in property since the mid-1990s. In fact, there's only been 2 occasions over the last 130 years where in Australia prices for houses and apartments and units have performed above a long-term average, which is just about inflation. The first one was after the Second World War. The second one was between the mid-1990s and just recently. And that was because we had financial deregulation. We had very loose lending standards. We have then the financial crisis and then interest rates being cut. And we had strong migration and we had the rise of property investors. All of those were positive forces that has distorted our property market so that we are very, very exposed. We have massive amounts of leverage in the property sector. And the problem is, if you look at debt to income ratios or debt to GDP, we are some of the most adverse around in the world. We have got prices way over their long term. Now, the point there is that if you actually think that prices are going to maintain that growth, double every 7 years, I think you're going to be sadly mistaken. My view is property prices are going to be in for a crash. And I will leave you at the end of this little piece of commentary with the last slide, which goes through my scenarios, but I'll touch on that in a second. Second point I want to make is that property is a very important asset class to understand, and you have to go granular. You have to look at individual properties, individual locations. Generally, units are performing much worse than houses. Houses close into the centre of towns are doing quite well relative to the high rise and relative to those on the fringe of towns. You have to go granular. You have to actually get into see the detail. And, there are average falls now of some postcodes of 25% from where they were even, a couple of years ago. Okay, there's a slight recovery, but they're now coming down. Other locations, not so much. So go granular. The third point I want to make is that for a property, if you buy a dog, it remains a dog. So this whole idea of buying a property and then converting it into something which is remarkable is very hard to do. You might be able to do it if you knock it down and build it something else. But generally, most people, when they buy property, don't do enough analysis to understand whether this property is actually really worth it or not. And, it amazes me how often you see years later, people are still struggling with this property. And by the way, fourth point is very few people, particularly on investment properties, do the math in terms of, what the real value of this investment is. If you did that, you'd have a really big shock. 6% of property investments are underwater, in my view. And then the final point is we have to get back to a view of property, not just as an investment asset class, but as somewhere to live. And so if you're making decisions about buying a property for a long-term place to live, to give you security and all those things, then you'll have a different set of priorities to those what you would have if you were making an investment decision. My worry is that we have those two things contaminated at the moment. So when people try to buy property, they're thinking of it like an investment class. That's a mistake in my view, and it's probably one of the reasons why we've got into the trouble we have, not least, of course, supported by poor government policy, the Reserve Bank effectively using the household sector and the property sector to try and support the broader economy. And by the way, the expectation is that probably they will try and do more to keep property prices up, because if property prices fall, then it hits the banks, and if the banks get into pressure, then that creates a broader financial problem for Australia. But we are in this terrible situation where prices have to adjust. So then the last question, and show me if you show the last slide, the last question then is, well, how would this look? Now, these are my scenarios, and just to be clear, I have never said property prices are going to fall 40%, full stop. Right? I've always said there are a range of different scenarios that you may see, but these are my current scenarios based on what I'm seeing with all the information from my core market models, all the other information analysis I do. So there is a small chance that if the RBA is absolutely right, and if they support the housing sector, dramatically, as some people have been calling, particularly from, guess what, the property sector, we could see over the next couple of years a very small rise in prices, but only got a 5% weighting. There is a chance that we get away with a small fall of between 5 and 15%. I give that a pretty low chance too, 5% last time, 7.5% this time. I update these every month. If you want to hear more about my scenarios, every time I go live on my Tuesday evening shows, I go through these scenarios. The third one, I call that the longer term crunch. There's a 45% chance that property prices will fall between 30 and 15% over the next couple of years, but there's a 32.5% chance that they could drop between 30 and 45%. And 30 or 45% would just get us back to where we started. It would actually be back to a long-term average. So one of the reasons why I keep saying the debt-fueled housing sector is way over where it should be. And if it comes back to its long-term trend, that's where prices would get to. And interestingly, if you compare prices here in Australia with, for example, the US, prices here are way higher than compared with the US, despite the fact they've got perhaps a better economy in many ways. So there's something really weird about our property sector, but it could well come back. And by the way, there is a small chance if, for example, we got the uncontrolled pandemic back. So let's assume that, if wave 2 and wave 3 happened on a global basis, then we could see a much more significant fall. So in conclusion, I just want to sort of just underscore the fact that property does not always go up. We've had a long run, we've had a good run, but we need to be very cautious and very careful now, because it's my view that over the next 2 to 5 years, we're going to see property prices falling. We're going to see a lot of people caught. We're going to see a lot of the banks caught with their liquidity issues and with their capital ratios, because as the loan to value ratios get worse, they have to put more capital in. We will see some level of default, but not immediately, because the banks will not want to close out on people. They will try and do all sorts of things. For example, switching to interest-only loans like Westpac did, or give further repayment holidays. But eventually, this property party, is going to come to an end, and I think we're facing right into it now. So the next 6 months to 12 months will confirm whether I'm right. But at the moment, I would say anybody thinking of buying property at the moment, be really, really cautious. If you're trying to sell early, because if you can sell early and get your equity out and find a greater fall, worth doing. But frankly, if you're a property investor, you should be very, very cautious at the moment, very, very concerned. If you're an owner-occupied holder of property and you see equity degrading and you can hold it for a long time, maybe not quite so much of a problem, but negative equity is a killer too, and it means that people can get locked into property. So be very cautious, be very careful at the moment, and frankly, I would be looking at property twice before I made any investment decisions now and probably over the next 6 to 12 months.